taking a much closer look at the alternative data sources, the private data sources, the alternative data that I'm mentioning there. We've had a lot of success scraping the wage inflation data or the wage posting data and extracting from it wage inflation measures. And one of the most important stories that I think everyone is aware of, when you came out of COVID, it was the bottom end that led the wage gains. And that shifted, and we've been in a period where, you guys have talked about it, the K-shaped recovery. We've talked about it a lot in this program, but that shifted where the bottom end was really weak, and it was the high end that was holding up. And the latest innovation in the data, we saw a little bit of a strength in the high end. Over the last 2 months, that's come out of the data and that's come back down. It's kind of brought the aggregate wage data back in line with where we were in the pre-COVID period. So it's not that bad, but you had this period of really aggregate wages that were above. Now you're coming back in line, and the change is a softening, and that softening is interestingly coming more from the high end than the bottom end.
Jeff, you're a PM. Is that sufficient reason to dial down risk?
So one of the things, as a PM in our process is, having a lot of inputs to the process. And so we're talking about one of what might be 100 different inputs. So we're going to weight that appropriately and not react to just one. But it is an important data point. And what does it point to? It points to a lot of what we're seeing in the market pricing, that most of what we're getting out of the alternative and the private data sources are kind of validating what we had as the last reading, which is the slowdown in the labor market. So it confirms a lot of what the other data sources say, and when it all lines up, it kind of points you into the one direction, which is 70% odds of the Fed continuing its cutting cycle here. When we talk in December.
Jeff, how much is a risk asset market really depending on that rate cut? I mean, it sort of seems like we're talking about two different worlds, whether it's the AI trade and risk assets that aren't necessarily hedged to the underlying economy or jobs market. And then we're talking about labor market data that is affecting what the Fed does. Is there a sense that this risk market needs at least another rate cut this year from the Federal Reserve to keep on going?
I think it depends on how risky you're talking about in terms of the risk market. Fixed income, the investment grade side, it's going to be much more dependent on that rate picture because there's just less credit spread. And so total returns are going to be much more about the rate side. I think when you start getting into the riskier parts of the market, like high yield, there's more credit spread. It's more credit sensitive. So that rate cut, whether they cut or they don't cut in December and all the things we gnash our teeth about, that's going to be less of an impact for that part of the portfolio. And the equity market outlook is going to be, much more important for the riskier parts of fixed income like high yield.
Jeff, since nothing really happened to cause this momentum unwind, and we actually got earnings from big tech that showed positive returns, are you buying right now? I mean, is this something that you're seeing as something that's just a momentary blip that gives you an opportunity to trade around?
If you look at what we were coming into, kind of end of September, first week of October, there's aggregate measures and there's a lot of focus on the aggregate, some headlines about Shiller, cyclically adjusted cap. But you look under the surface and you saw some very extreme moves in terms of valuation. We talked about this as the market moving from optimism, from the post-Liberation Day concerns, that was kind of June, July, to when the Fed got involved, when they started to signal a bigger preference for labor markets to drive their decision-making, that really shifted the market from optimism to euphoria. So valuations got very extended. They got particularly extended in the cross-section and the differential characteristics. A lot of high-risk pricing in the equity market, a lot of anti-beta, which means people were really not looking for defense. They were really on the offense, and they got a little overextended. And I think that's what you're seeing here in the pullback. Absent a big change to the macro outlook, that can be a buying opportunity. We're not buying today. We're going to see how long this revaluation plays out. But, without a big change in the macro outlook, this is really kind of a pullback from what was some very extended euphoric type valuations in the equity market.
Jeff, just a final question from me. Is there a sweet spot in the market right now for you? Somewhere you see an asymmetry of risk, somewhere you want to be, somewhere you're comfortable?
Yeah, I mean, if we talk about kind of the risk side and the risky side, you know, on the risk-free side, the sweet spot I think is still kind of in that middle part of the curve, you know, 5s to 7s. You know, the Fed here is asymmetric, to talk about, you know, your question. You know, they're going to be very responsive. Right now they're talking about normalization, and so that's giving a little bit of support to that part of the curve. But if normalization gets shocked, you were talking in the earlier part of the segment, you know, the dependency on consumption to the wealth effect, right? This is the inverted market. The stock market cares more about the sorry, I just got that wrong. The economy cares more about the stock market than the stock market cares about the economy. Because what's driving the economy is consumption and wealth effect. So if you got to pull back there, you know, the Fed's going to be very responsive, and that part is not normalization. That's more of a Fed cutting cycle. And that part of the curve initially, I think, will benefit. On the risky side, you know, it's a carry story. It's asymmetric to the downside, but as you're talking about, earnings are strong, corporate balance sheets are strong, the economy and measurements, we've kind of eased off of this concerns that we had earlier in this year. And so that's a carry trade. You know, you understand that that's income against downside, but the downside seems pretty limited, so you can take that carry.
Hey, Jeff, good to see you, as always. Maybe next time we do this, we've got some data. I don't know. Maybe. Jeff Rosenberg of BlackRock. We can only hope.